2017, the least volatile market in history. What's next and how to position yourself for 2018. Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV. First up, don't forget to subscribe to our channel. Also below, show more for additional links and information on today's video. So let's get right to the numbers ending 2017, and we're going to focus on the laggards, small and big cap. Yes, it was a strong market last year, but heading into 2018, we like small and mids. One, I think the markets are cyclical, but two, who benefits more from the tax plan? We believe the small and mid-sized companies. So next up, let's get right to the big charts. NASDAQ, we talked about that. Straight rider all year. Strongest sector of the year as well. Technology. But at the end of the year, we saw a momentum turn at the bottom there. MACD momentum. You had a negative crossover. RSI's pointing down to top. Relative strength. So it tells us to be a little bit cautious here. And maybe it might be an opportunity. Now that was the case in 2017. Every time we saw a pullback or a consolidation, the markets went to another level. Will we see it again in 18? We'll see. Next up, weekly view. Same thing. We're seeing a momentum turnover there as well at the bottom of the page. At the top, RSI, and you can see how overbought we are and when we've seen it in other times in history. So another theme as we head into 18. Next up, Dow Jones Daily. 71 all-time highs last year. That is the most in history. Now, heading into the end of the year, we did see a short-term crossover as well. Way overbought conditions up top on the short-term view, so maybe a consolidation or a little bit of a pullback as we head into 2018. So the move on the Dow last year was amazing. When you look here, 1,000-point moves. November of 16, we're at 19, and then we went 20, 21, 22, 23, 24, and just missed 25 by 100 points at the end of the year there. So really big moves in 2017, and that's why we're quite a bit overbought. When you look here, this is what I've done. At the bottom, relative strength. The last time we were this overbought goes back to 1986. Again, continuing that theme, S&P shot up, momentum on the bottom, a negative crossover at the bottom, a little bit of a consolidation or a potential pullback. We will see, time will tell. Weekly view, way overbought again, right? It looks really good. By the way, our first negative weekly read since August, so something to watch as well. But when you look at the overall weekly overbought sign on RSI, how about going back to 1958 to find a similar read? So definitely a concerning view. Next up, we're going to talk about market breadth. The 200 moving average, still very much strong. Seeing a little bit of a deterioration here on the 50-day. So those companies above or below the 50-day moving average, if you're above 60, that is very bullish. So S&P still strong at 73. You've got 63 down to 68 on the NASDAQ 100. So we're going to watch that mid 72 to 68. And small 65 to 59. So short term, seeing some deterioration. How about international? Not going to get too much into it. Still going to keep international heading into next year. Emerging markets was the big darling, so to speak. And we did see some deterioration, though, across the board in emerging markets as we went into the end of the year. Next up, sectors. A lot of sectors here put on the screen across the board. Pretty strong when you look at materials, consumer discretion, staples, all strong. Really, the only weak here at the end of the chart is going to be utilities, and a lot of that happened at the end of the year. And REITs, the publicly traded REITs, struggled last year with negative numbers. Obviously, a lot of correlation to interest rates on that. Talking more about the sectors. What are we like heading into next year? Continue to stay with financials, a little bit of a consolidation right now. But as rates go up, financials should be a good sector to stay into. Oil, we've been showing this. We've had the golden cross up quite a bit, only 12%, but had a nice surge there from mid-year, breaking out, etc. What I really like about this, though, is the opportunity. Not a lot of upside opportunity in sectors because we've hit all-time highs everywhere. Well, here, high to low, down 70%. Where we are today to the most recent high, an 80% upside opportunity. So like oil for this reason, obviously you look there, also that green line, that's resistance. Let's see what happens. We're getting a little bit of a consolidation, but closed above 60 for the first time at the end of the year. But we will be adding oil to our overall portfolios. So next up, the story of 2017-18 treasuries. The yield spread, 10-year treasury -2, down to 0.51%. This is concerning. Lowest read since before the last crash. This tells us a couple things. The markets aren't really, or the bond market isn't really believing the surge up. They feel inflation is coming, rates continue to get higher, and we're going to talk more about this as we look at 18. So let's focus on 2018. First, we talked about our smalls and mids. Wrapping up last year, can it continue? When you look here, S&P had 12 up months, first time in history. We've had 9 straight years of up numbers. 3 times in history we've seen that. This market is stretched. How stretched? 32.46 on the PE. Kate, cyclically adjusted price earnings, Robert Shiller that we follow. Let's talk about getting to maybe overvalue, and if the CAPE went to a 20 number, we're looking at 21.42. That's a 20% correction. If we go to fair value, which is 15, all right, we're looking at a 40% correction, and in that case, we're looking at 1606 on the chart. So, not saying this is going to happen, because if you go undervalue, be a 60% correction, but this is how overstretched we are. And at some point, we have to see some type of pullback. A lot of folks are calling this the most important chart of 2018. This is our treasury yields, okay, from high to low, all right, going all the way back to the 80s. Obviously, you see that channel, one of the longest bull markets in history in bond markets. Yields go down, prices go up. But you look at that channel, and each time we've hit the top of that channel, tech bubble, housing crisis, let's see what happens here, because obviously rates are going up. How quick can we go? If we hit that 3%, something we have to continue to watch. Speaking of yields, the big story had been TINA. There is no alternative. Well, now there is. 2-year treasury is the same as the S&P yield. So for older clients, they may not be looking for that risk. We're having opportunity now, 2-year, 5-year, 10-year, to pick up a little bit better yield. Volatility, we talked about this in the opening. Least volatile market on record, history, lowest average. Also our lowest high on average. Does that make sense? Lowest high. Right, so no volatility in the markets being cyclical. When we're this calm, you have to kind of expect a little more volatility as we head into 18. Not predicting, but if history repeats itself, we have to be concerned. AAII, consumer sentiment, showing from 1129. The market was neutral. How about today? 52% are now bullish, only 20% bearish. That is a contrarian view. So we have to continue to watch that, which brings us to fear and greed down to neutral, so a little bit different from AAII. Our indicators, all positive, short-term, mid-term, long-term. So we are invested but we are obviously a little bit concerned about the overpricing of the market right now. So back to my theme, stay nimble, be open and ready for moves. We're going to start the year probably again at another 5% cash position. Give us an opportunity to maybe hedge, or as opportunity presents itself, because I think the market needs to figure itself out in the first few weeks here. New tax plan, implications, tax selling, etc. Let's see what happens and be a little bit patient the first couple of weeks. As always, thanks for watching. This is Michael Loftus for Wealth and Wisdom TV.